In Chapter 3, we are going to look at the complete accounting cycle that we had introduced in Chapter 2. And as part of this accounting cycle, we are going to look at the accrual basis of accounting versus the cash basis of accounting, which is a very important concept for you to understand. The adjustment process will involve the preparation of adjusting journal entries. And so we are going to look at a variety of journal entries, adjusting journal entries. And then we will prepare an adjusted trial balance and then go through the closing process that would get us ready for the next accounting cycle. And once that is done, we prepare a post-closing trial balance. So Chapter 3 concludes the accounting cycle, so to speak. And so we're going to start our discussion by looking at this accounting cycle. And I'm going to walk you through the accounting cycle and tell you what we've done so far and where we are headed. So we first analyzed transactions, and we've done that right from Chapter 1. Then in Chapter 2, we journalized those transactions, posted them to T accounts, i.e. ledger, and then prepared an unadjusted trial balance. So we prepared a trial balance. We just didn't call it an unadjusted trial balance, but it was a trial balance that was not yet adjusted. Why? Because some of the accounts are not at their correct balances and need adjustments, so we go through the adjustment process. Once that is done, we prepare another trial balance called the adjusted trial balance. Use that trial balance to prepare financial statements. So we're going to take another look at financial statements in this chapter. Then we go through what is called the closing process. And finally, we prepare a post-closing trial balance. We are not going to be doing reversing journal entries. Once the post-closing trial balance is prepared, we start the accounting cycle all over again for the next accounting period. So, what is an accounting period? An accounting period is any period of time you choose to report about. A business's life is going to continue on, and at some point you have to report to your users about activities that took place in a particular accounting period. And that accounting period could be a month, it could be a quarter, it could be semi-annual, or it could be annual. Some companies even have a fiscal year that they report about, which is a period of 12 months, which begins anywhere in the year and ends 12 months later. So it could begin on March 1st and end on February 28th of the following year. Or it could begin on June 1st and end on May 31st of the following year. That is a fiscal period. So next we're going to discuss the accrual basis versus the cash basis of accounting. And we have really been following the accrual basis of accounting. You really didn't think of it as being the accrual basis. So what is the accrual basis? Under the accrual basis, revenues are recognized or recorded when they are earned, which is when products or services are provided to users, to customers. And expenses are recognized or recorded when incurred, that is when we have received some benefit. So we are not worried whether we paid cash for those expenses or we received cash for the revenues. All that we are concerned with is, did we earn these revenues or did we incur these expenses? On the other hand, the cash basis of accounting, revenues are recognized when cash is received and expenses are recognized when cash is paid. So everything follows cash. We record revenues when cash comes in. We record expenses when cash is paid out. So the cash basis of accounting is not a practical method for a large business because very often does cash happen simultaneously with the revenues or the expenses. Furthermore, the cash basis is not consistent with GAAP. So in accounting, GAAP requires us to follow the accrual basis of accounting, where we record revenues when we earn them and we record expenses when we incur them. So here is an example of the accrual basis versus the cash basis. So here we make a payment of $2,400 for a 24-month insurance policy beginning December 1, 2008. If we were a cash basis business, we would record the entire $2,400 as an expense for the month of December, which would mean that the expenses for December would be high and the income for December would be low. Now, this would not really be appropriate because this policy is for a 2-year period. And so we are going to get benefit from it for a 2-year period. And so if we followed the accrual basis of accounting of recording expenses when we incurred them, which is when we receive benefit from them, then we would have spread the 2400 over a 2-year period as follows. And this would be a true representation of when the expense was really incurred, okay, and would also match up with the benefit that we've received from the policy. So the accrual basis of accounting is based on 2 principles, the revenue recognition principle and the matching principle. And we'd introduce these principles in chapter 1. So under the revenue recognition principle, revenues are recorded when these are earned. That is when products or services are provided to customers. Whether or not we've received cash for those revenues is irrelevant. Okay. And the accrual basis of accounting is also based on the matching principle, also called the expense recognition principle, which tells us to record revenues that were incurred to generate the revenues recorded in the accounting period. So in order for us to earn revenues, we had to incur expenses, and so the matching principle tells us to record the expenses in the same period in which we recorded the revenues that those expenses helped to generate. So we're going to go through an exercise here which helps us with understanding the accrual basis of accounting, and you should really follow how the accrual basis works. So the first item, we have paid $600 for 6 months insurance on March 1. And here we have to identify whether we are going to record revenue or we are going to record an expense under the accrual basis. So if we paid $600 for 6 months insurance on March 1, how much of it would we record as an expense? Would we record the entire 600? And the answer to that is no. We would record just $100 of that as an expense under the accrual basis. Item 2, billed a client $500 for services performed in March. Now, we haven't received cash. So can we record revenue? Answer to that is yes. And what are the key words here? Services performed. We performed services, we can record revenue. So yes, we will record revenues of $500. Item 3, received $1,000 cash for services to be performed later in the year. Can we record the $1,000 as revenue? Answer is no. Why not? Because we haven't yet done our bit. We haven't yet provided the services. The services are yet to be performed, and therefore we cannot recognize either revenue or, the question of expense doesn't occur at all. Number 4. Received a bill for $400 for electrical services for March. Here we've received a bill. We haven't paid cash. We've just received a bill for services that we received for March. Should we record this as an expense? Answer is yes. Why? Because the services were for the month of March and we've received a bill for the services that we already received for March. And so we've received the benefit, we get to record that as an expense. Item 5, completed 25% of the services for a client from whom an advance payment of $1,200 was received in February. So in February, we had received this advance payment and we had not performed any services. So we had not recorded any revenues. Now in March, we are providing 25% of the services. And so how much revenue do we get to record? We get to record 25% of the $1,200 as revenue, which is $300 as revenue. Item 6, invested $10,000 in the business in exchange of stock. Now here we are asked to just record either revenues or expenses. And item 6 has nothing to do with revenues or expenses. Rather, it is an investment that the owner makes in the business. So it does not involve revenues or expenses. Item 7, we pay 10% of the amount owed for consulting services of $500 received in March. And so here we have received consulting services worth $500, but we are paying 10% of the amount owed. So it doesn't really matter what we've paid. What matters is the benefit we've received, and the benefit we've received is worth $500, and so we do have to record an expense of $500. Item 8, performed services of $1,200 for a client in March and received $250 from the client, balance to be received in April. So this is kind of the opposite of 7. Here we provided services worth $1,200 and we got $250 from the client. How much of a revenue should we record? $250 or $1,200? Here we ask ourselves the question, how much was the value of the benefit we provided? And the value of the benefit we provided was $1,200. So yes, we get to record revenues of $1,200. So this exercise is important for us in terms of identifying the revenues and expenses that we would record under the accrual basis of accounting. And this would help us determine net income under the accrual basis of accounting. Since GAAP requires us to follow the accrual basis of accounting and requires us to record revenues that we've earned and expenses that we've incurred, even though cash was not paid or received, so some of the accounts as a result of that are not at their proper balances, and some accounts need to be recorded which are not recorded. So as a result of that, we have to adjust the balances of certain accounts so that we adhere to the accrual basis of accounting. And in order for us to correct account balances, bring them to their correct balances, we have to prepare adjusting journal entries, which will then get posted. And once those entries are posted, those accounts will come back to their correct balances. So an adjusting entry is recorded to bring an asset or a liability account to its proper amount and ensure that the revenue recognition and the matching principle are followed. And so what we have is different types of adjusting entries that we prepare. Adjusting entries are broadly broken down into two categories, deferred and accrued. So the first type of adjusting entry is a deferred adjusting entry. The word deferred means delay. Delay in recording an expense or a revenue. So we have two types of deferred adjusting entry. We have deferred expenses, also called prepaid expenses. And these occur in situations where the cash is paid before the expense is recorded. And an example of that is prepaid insurance, prepaid rent. So those were situations where cash was paid ahead of time, but now with the passage of time, the expense needs to be recorded because we've received the benefit. The next deferred adjusting entry is unearned revenues. And under unearned revenues, cash is received before revenue is recognized. And an example of that is unearned rent, where one of our customers pays us in advance of receiving products or services from us. And so when we receive that advance payment, we record that as a liability, and only with the passage of time do we record a revenue. So to record the revenue, we need to prepare an adjusting journal entry. The second type is accrued adjusting entries. The word accrued means to provide for something, to make a provision for something. And so there are two types of accrued adjusting entries. We have accrued expenses, also referred to as accrued liabilities, and these occur when cash is paid after the expense is recognized. So what we have here is we've incurred an expense, so we need to go ahead and record it even though the cash has not been paid. And examples are all your payables. The next type of accrued adjusting entry is accrued revenues, and these are also referred to as accrued assets, and these occur when cash is received after the revenue is recognized. So here is a situation where we've provided products or services to customers and they haven't yet paid us, but since we have done our bit of providing the service, providing the product, we need to go ahead and record that as revenue, and therefore we need to make an adjusting journal entry to record this revenue that we have earned but not yet received in cash. Another form of a prepaid expense is depreciation. Okay, is the adjusting entry for depreciation, and we're going to discuss that when we talk about prepaid expenses. So what I'd like for you to do now is look at the video for the examples of adjusting entries, and then look at the video for the adjusting entries problem that I have solved for you. So both these will help you get started. The first one will help you understand the different types of adjusting entries, and I have different examples, a variety of examples there. And the second one will help you, solve a problem with respect to adjusting journal entries. And while these might seem hard initially, the more of these you solve, the better you will feel about them and the easier and easier they get. So it's all about practice, practice, practice as far as the adjusting journal entries are concerned.